Hi, everybody. Let's go ahead and continue with chapter 3. We lectured on HAEs last time, and I gave you a handout to do. So we're going to start by going over that. And then I'm going to lecture a little bit more, do some reinforcement work on adjusting journal entries. And then I'm going to give you some more homework to do and another handout. And this is all getting you ready for going on Connect to do your reading quiz and your chapter homework for points in Connect. So let's pop over to the other screen and take a look at your handout that was due. Okay, so these were just some basic questions I need to ensure that you know how to or why we're doing these adjusting journal entries and what's going on with them. So the first question was, why do we do adjusting journal entries? And the answer to that question is that we do them in order to comply with accrual accounting. And accrual accounting is mandated by GAAP, generally accepted accounting principles. And what accrual accounting says is we recognize revenue when it's earned, not when the cash trades hands. And we have to recognize expenses when they're incurred and to match them with the revenues that they help to earn, not when the cash trades hands. So the whole reason we do all these adjusting journal entries is it doesn't matter when cash transactions transpire. It matters when things were earned or incurred. And then the other piece of that, I guess I'm jumping right into here. What is accrual accounting? The other piece of this is that in the life of the business, we split it up into time periods, right? That's called the periodicity assumption. And it depends upon how often we close our books, right? Monthly, quarterly, annually. Whenever we close our books, that's when we have to make sure everything is complying with accrual accounting. All right, what are the four main types of adjusting journal entries? Well, the first, and I'm just going to do them in the order that we talked about them before, is deferred, also known as unearned, same word, deferred and unearned revenues. And this is when you have earned a revenue but not gotten cash. And the example that I used last time for that, a couple examples, is I own a magazine publication or a digital musical platform or any sort of thing where my client pays me for, say, a year worth of streaming service, and then I've gotten a bunch of cash, but I haven't, sorry, I did this exactly backwards. Please forgive me. I have received cash, but not earned the revenue. But that would have been confusing. Okay, so you've paid me a whole bunch of money. And then now for the next year, I have got to provide you a service. I've got to give you access to the streaming service, right? So when I get the cash, I've got to debit cash, but what do I credit? And the answer is unearned revenue. And what kind of account is this? It's a liability because I owe you the service. The second type of major adjusting entry is a deferred expense, and that's also known as prepaid. Okay, so this is, I have paid cash, but I haven't incurred the expense yet. Well, what's an example of that? Let's say that I've got a fleet of autos for my salespeople in my company, and my insurance agent says, hey, Lisa, you have to prepay 6 months of auto insurance. So I cut them a check for $10,000, and now they have to insure my fleet for the next 6 months. So what do I have to debit in this case? A prepaid expense. What is a prepaid expense? It's an asset because I own the right to be insured. And then I'm crediting cash. Both of these types, these are the actual transactions that originated. And then these are the kinds of things that I'm going to need to adjust for at the end of the month or the quarter or the year. Okay, so these are the original transactions, not the AJEs. Okay, then we have something called accrued revenue, which means I've earned the revenue, but the cash hasn't happened yet. Okay, so with these, there is no original transaction because no cash has transpired. I have to go to the end of the month, and at that point in time, I'm going to debit accounts receivable because I have a right to receive some cash, and then I'm going to credit some sort of revenue account. Okay. Then when they give me the money down the road, that's when the cash transaction occurs. And the last type, again, there's no original entry because no cash has transpired. I've incurred an expense, but not yet paid the cash. I'm going to have to debit some sort of expense, and I'm going to credit some type of accounts payable. Okay. And then when the cash transpires down the road, I will have to acknowledge that. So this is actually an AJE. This is actually an AJE. And these two are the original journal entries. Well, what are the AJEs for those? Okay, so the AJE for a deferred revenue is at the end of that period. I have to acknowledge that I've earned some of this revenue. So I've got to decrease my liability. So debit it, right? And then I have to record some sort of revenue, right? Consulting revenue or whatever. So this is actually the AJE. This is the original journal entry that impacts cash. This is the adjusting journal entry. With deferred or prepaid expenses, at the end of the period, it's like, oh, wow, I've used up some of my asset, right? So they've actually covered me for a month of my car insurance. So I'm going to debit insurance expense and get rid of a piece of my asset. How do we decrease an asset? We credit it. And those are my 4 journal entries in black, okay? And then we learned about a special type of AJE, which was it's a type of prepaid expense. What do we do when we have, I'll put this as a special type of prepaid expense. What happens when we buy a plant asset? Okay, that's a big prepaid expense and we use up a little piece of it, right, over a long period of time, and that's called depreciation. And remember, depreciation doesn't mean that the value of the asset's gone down. It's just a way of allocating a big asset over the period that it helps to benefit. And this special type of writing off a plant asset or a fixed asset over time, we debit depreciation expense and we credit that very special new type of account we learned about, accumulated depreciation. And then you have to put the type of asset that you're depreciating. Is it equipment? Is it a building? Is it, I'm seeing here too, is it a, car? What is it? Is it a piece of equipment? And this is a profit and loss account. It's got a debit balance, it's expense. Accumulated depreciation is a contra asset and it's got a credit type expense, and it goes on the balance sheet against the type of fixed asset that you're writing off over time. So those are the four main types: deferred revenue, deferred expense, accrued revenue, and accrued expense. All right, here's some true and false. An adjusting journal entry always uses one P&L account and one balance sheet account. That is true. Interest equals principal times rate times time. So let's say I've got $101,000 note payable with a 4% annual percentage rate. Oops, I don't want to have that on caps. Note payable. Okay, so that's how much I owe somebody. I just borrowed $101,000. It's got a 4% annual percentage rate, and it's got a 5-year term. And if I were to try and calculate how much interest has accrued for 3 months, the calculation is just what we said here: principal times rate, 4%, times time. And time is always something divided by 12, right? Because 12 months, and this is an annual percentage rate. And if I'm accruing interest for 3 months, my numerator is 3. So the answer to this is yes, this is true. This is how I calculate interest. And we'll be practicing that. Accumulated depreciation is a profit and loss account. No, it's a contra asset. It has a credit balance. It goes on the balance sheet, not the P&L. That's false. Accrued wages in April that are paid in May should be reflected on May's profit and loss. Okay, think about this. So this is an example of an accrued expense. I've incurred the expense in April because my employees have worked for me, but I'm not paying them until May. So I need to make an AJ at the end of the month to debit expense and credit, in this case, wages payable, right? So this is false. It's not reflected on May's P&L. It's going to be reflected on April's P&L. Unearned revenues decrease every month that the service is performed. So again, unearned revenue is a liability. I owe you 12 months of streaming services because you've given me a chunk of money for the whole year as my customer. So every month that I provide that streaming service, is it true that a little piece of that unearned revenue decreases? Yes, it decreases every month that the service is performed. All right, now label the following kinds of accounts as to the type of balance. Is it a normal debit balance or a normal credit balance? And what kind of account is it? So let's just go through these. Accumulated depreciation is a contra asset with a credit balance, and it goes on the balance sheet. Unearned fees is a liability account. It goes on the balance sheet and it has a credit balance. Anytime you see the word unearned, you know that's a liability. I owe somebody something. Prepaid insurance. Anytime you see the word prepaid, it means it's a debit type account. It goes on the balance sheet and it's an asset. Anytime you see the word payable, that means it's a liability. It goes on the balance sheet. It has a credit type balance. Anytime you see the word earned or revenue, it's a P&L account. It has a credit balance and it goes, and it's a revenue type account. Okay, here's that word payable again, interest payable. Remember, we just calculated that up here. I have an outstanding note and now I owe them money, some interest for 3 months. So 101,000 times 0.04 times 3 divided by 12. I owe them, I still owe them the note that I borrowed, and I owe them another $1,010 for interest payable. This is a liability account. It has a credit balance, and it goes on the balance sheet. So you've got the note payable itself, and now I've got some additional interest that I need to accrue. It's an accrued expense. Depreciation expense, anytime we see the word expense, of course, that is a P&L account. It goes debit balance, and it is an expense. And again, here we see the word earned. That means it's a revenue account, credit balance, and it goes on the P&L. Okay, good job. So let's take a look. Let's finish off the slides for this chapter. I think we were, yeah, we did each of the 4 types of journal entries, adjusting journal entries for deferred revenue, deferred expense, accrued revenue, accrued expense. And now we've made our AJEs. So whenever you make a journal entry, what's the next thing that you do? And of course, the next thing that you do is you post your journal entries to the ledger. We've been using T accounts, but you actually post to that little ledger that I had loaded in Unit 2. And then you run a trial balance. We learned to run a trial balance in Chapter 2, and that was called an unadjusted trial balance because we hadn't made our AJEs yet. Now we've made our AJEs, it's called an adjusted trial balance. And here's what it looks like. So here was your unadjusted trial balance, all of your accounts, same order every time, assets, liabilities, equity, capital, withdrawals, revenue, and expense. Same order every time. Here was my unadjusted debits equals credits. The whole reason we run a trial balance is to make sure that we have posted correctly and everything's in balance. Here's my AJEs, right? You can kind of follow them like a debit of $100 to insurance expense, credit to prepaid of $100. That was an AJE for deferred expenses, right? And B, debited supplies expense, credited the asset of supplies, another example of a prepaid expense, AJE, et cetera, et cetera. So here's the 2 columns next to the unadjusted trial balance where I put all of my AJEs. Okay, I've posted them to the ledger. This is just a tool. It's not a financial statement. It's just a tool to make sure that I'm all balanced out before I do my P&L, my statement of owner's equity, and my balance sheet. And I do it all. And you can see here the way it works is, for example, I had a 0 beginning balance in my trial balance in AR. So 0 plus a debit of 1,800, I pull that over here, 1,800. Supplies, I started with a debit of 9,720. My AJE is a credit, so that goes against it, right? So 9,720 minus 1,050, 8,670 is what I pull over to my adjusted trial balance. Let's do one more. So prepaid insurance started with a debit balance of 2,400. Then I had an AJE of a credit of $100. So I pull over $2,300 debit, etc. Now I'm going to use all these numbers to prepare my financial statements. And we know what order we do those in. We prepare our P&L using revenue and expense balances. Okay, so here's my consulting revenue, $7,850, rent revenue, $300. Here's all my expenses. Those go in alphabetical order on your P&L. And then I get my profit or loss. Then I do my owner's equity. Remember, that's beginning balance, plus any new investments, plus or minus net income and loss, minus drawing. And then I get my ending balance in capital, and now I can do my balance sheet. And then my last statement is a statement of cash flows, but we're not working on that in this class. So here are my financial statements that I pulled right from the adjusted trial balance, right? P&L first, statement of owner's equity next, balance sheet last. And then for this chapter, the ratio we're going to learn is something called profit margin. Profit margin lets us know how well we're doing income-wise compared to our sales. And the calculation is net income divided by net sales. So it's pretty easy. We can just get it all right off of our profit and loss, right? Our income statement. Okay, and they're showing us here a couple companies, Visa, MasterCard, what their profit margins looked like over time compared to MasterCard over time. Clearly, Visa is doing producing more profit per dollar of sales than MasterCard is. Okay, so what I'd like you to do is we are going to, let me give you some homework to do. So I'm going to go back to the website, to Moodle, and you can see that I've asked you, so you're listening to lecture 2 and then do quick study 3-4, quick study 3-6. Okay, these are all quick studies. They start on page 106. And that shouldn't take you very long. They're pretty, a pretty beginning type of study here, AJEs. Then the last lecture I'm going to have is we are going to work from handout number 2. And handout number 2 is also on your Moodle. And these are adjusting journal entries that are a little bit more difficult and challenging that I'm asking you to do. So in the next lecture, we'll go over the first few of them together. We'll do them together. And then I'll ask you to finish up this handout and do some more challenging homework. And that will wrap up what I'm asking you to do for chapter 3. And then you're prepared, hopefully, to go to Connect and do your reading quiz and your chapter homework there. So go ahead, please do these quick studies. And then I will meet you for the last lecture starting over handout number 2. Okay, thanks, bye.